Hi, my name is Ryan Sweet. I'm a wealth management advisor here at Cutler Investment Group in our Anchorage, Alaska office. Been in Alaska for 15 years after growing up in the Pacific Northwest. When I moved to Alaska, I met my beautiful wife. We now have 2 kids, Sienna and Gus. In our spare time, we love seeing the outdoors in Alaska. I'm still big into playing team sports, but more oftentimes now you're going to see me coaching the kids as opposed to playing myself. One of the reasons that I love Cutler Investment Group is the team aspect that we have here. When you work with Cutler, you get a true team experience. I may be the advisor, but there's an entire team working tirelessly behind me for all of our clients. No matter what stage of life you're in or where you're at in your financial journey, we're excited to work with you. Today we're going to be talking about employee benefits. It is definitely something that can be scary for the individual, but if you work with your financial professional, it definitely does not have to be as daunting as you may think. Today, we're going to talk about really 6 key things. We're going to talk about health insurance, the difference between FSA and HSA, dental and vision, retirement plans, other insurance benefits that you may be offered at your work, as well as any other miscellaneous benefits that are available. So today we're going to start with your health insurance plans. So there's really 3 types of plans that generally we see in the workplace. Before I get into those, there's 4 key terms that I really want to discuss. First of which is going to be your premiums. That premium that you pay is the amount of money that is going to cost to have that health insurance plan. Next is deductibles. And what a deductible is it's the amount of money that you have to pay out of pocket for those services to your healthcare provider before your insurance is going to step in and take care of that cost. Next is going to be your co-insurance. But co-insurance is the percentage that you're going to pay of that service provided from your doctor, from your medical physician. So a lot of times it's something like an 80-20 split, and what that is the doctor is going to be paid 80% through your insurance, and then 20% is going to come out of your pocket. Last is that out-of-pocket max, and this is important to a lot of people. Out-of-pocket max is the most that you're going to have to pay out of your own pocket before everything is taken care of through your health insurance. And this is important because if you ever do hit that out-of-pocket max, generally you're going to want to take care of anything insurance associated that year because it's all going to be paid for through your insurance company. So when we go through the different types of insurance, the first is your HMO or your health maintenance organization. That's going to be the lowest cost of premium, meaning the lowest amount that you're going to have to pay for the insurance. But generally, you're going to have a primary care physician to refer you to any of your specialists for any of your needs. Generally, they have a limited network of providers that you're going to be able to use. Next is going to be PPO or your preferred provider organization. They're going to have higher premiums that you pay, so higher amounts that you'll have to pay for the insurance coverage, but there's no need for referral to those specialists. And there's a lot of flexibility that you can have when picking your provider out of your network. And then lastly is going to be your high deductible health plan. And that is going to be lower monthly premiums, but it's going to be a higher cost out of pocket before your insurance is going to pay anything. A lot of times, and most times, high deductible health plans are eligible for your HSA accounts. And I'm going to get into the differences between your HSA and your FSA here next. So when you have a HSA, it's a health savings plan, they're only available with those high deductible health plans. The great part about these is that they are triple tax benefits. So what that means is that you're not going to pay taxes when the money comes out of your paycheck. The growth in those accounts is not going to be taxed. And lastly, if you are using that money for a qualified expense, those dollars will not have any taxes when they come out of the account. Great part about these plans is that they are going to roll over each year, so you don't have to worry about spending that money in the given year. So oftentimes these also can be used for a long-term investment tool. And for example, you can use these for a hedge against healthcare costs before you get to the age of 65 and Medicare. Oftentimes, you can also use these for a retirement tool to supplement retirement, because if you do not use these funds for your medical expenses, we actually can pay the taxes on the back end and use these as supplemental income for your retirement. Flexible spending accounts are a little bit different. So they are available with most healthcare plans, but you're going to have to use it in the given year or you're going to lose those funds. They do reduce your taxable income, but they're a lot less flexible than those health savings accounts. Both have their reasons and both are valuable tools to use when it comes to your financial plan. talk to your financial professional and figure out which one of these plans is right for you. Other insurances that you might be offered at your workplace is dental insurance, which is a great tool to have, especially for those of us that have young kids. With the cost of those dental procedures, cavities for young kids, it's definitely a valuable insurance to have in your plan. Vision insurance is also offered through some employers. It's a great tool to have when it comes to your insurance portfolio. You don't know if you're going to need it, but when you do need it, it's definitely great that you have it. So next we're gonna talk about retirement plans. There are multiple different types of retirement plans. One thing that I want you to take away from this is to really maximize and take advantage of the benefits that your employer offers. So when it comes to a 401k, they're set up in multiple ways, but traditionally you're gonna have a couple options. First of which is gonna be your traditional 401k. And that is gonna be pre-tax dollars that go into your account that are gonna grow tax deferred, and then when the money comes out, that's when you're gonna pay your income tax. Generally, these are better when you are expecting to be in a lower tax bracket when you get to retirement. Next is gonna be the Roth 401k, which not all 401ks have this option, but if you have a Roth 401k option, that's when you pay taxes now, the money goes in after tax, the growth is deferred, and then you have no taxes when the money comes out on the back end. Generally, these are ideal when you expect to be in a higher tax bracket later on in life, and you want to have less taxes when you retire. The employer match, which I'm going to touch on multiple times, is a key portion of the 401k. That's free money that they're going to match dollar for dollar on whatever percentage your employer offers. And sometimes plans specify that they give you an option for an after-tax 401k. I'm not going to dive too far into that today, but if you do have an after-tax retirement plan or an after-tax 401k retirement plan, make sure you talk to your financial advisor and ask what the benefits might be for that plan. So, importances of your 401k, tax advantages are a big deal when it comes to using that traditional 401k. And what I mean by that is you can lower your taxable income by contributing to that traditional 401k to lower your taxes now to hopefully pay less taxes down the road. Long-term growth is a key component to your 401k because it's going to compound that interest and those dollars are going to grow on top of those dollars. The longer time frame that you have for retirement, the more you're going to get compounding inside of that account. Every year, the contribution limits change when it comes to the amount that you can put into that 401k. In 2024, you were able to put $23,000 annually with a catch-up contribution of an additional $7,500 if you're over the age of 50. What is an employer match? Employer match is a dollar-for-dollar match on whatever percentage your plan specifies that comes from your employer directly into your 401k. Whether you put your money into your Roth 401k or your traditional 401k, that employer matches those funds and essentially gives you a 100% return on the dollars that you put into the account. This is very important specifically for the long term because you're immediately getting that 100% match on your money, and all of those dollars are going to continue to compound until you get to your age of retirement. For an action item, if you are not putting at least the match into your 401k, I highly recommend figuring out what the match is on your 401k and immediately going in and at least giving yourself that free raise. The idea of compounding interest is the longer that you have, the higher your dollar is going to be able to grow because those dollars build on each other. For example, if you're contributing $200 a month, starting at age 25 compared to age 35, you could have nearly double your retirement savings by the time you reach that age of retirement. It is never too late to start, and increasing those contributions to help you catch up should you have started later, make it so that you can get back on track for that retirement goal. So for a real life scenario, somebody that starts at the age of 35 is still going to be able to have substantial retirement savings if they take advantage of those key components of their plan, whether that be the 401k match or that catch-up contribution the IRS offers past the age of 50. So some key takeaways when it comes to 401k plans. Number one, don't leave any money on the table. Make sure that you're taking advantage of those employer matches and give yourself that immediate raise. Make sure you choose the right plan. Whether it is a traditional 401k or a Roth 401k, they both have their place. Talk to your financial professional or your financial advisor to make sure that your plan is working for you the way that it should be. Start early and don't panic. Make sure you're taking advantage of all of those benefits that your employer offers. Oftentimes, there are some additional insurances that employers offer. The first of which is life insurance. Generally, group life insurance is something that is offered at a very minimal value to their employers, but you have the option to get additional life insurance. When I look at life insurance for employers, what I would say is figure out if it's portable. The last thing you want to do is sign up for additional life insurance at a cost to you, and then you leave your employer and that policy doesn't go with you. Disability insurance is something that is offered generally supplemental to employer covered benefits. But when it is offered, it's something that can help replace your income should you become unable to work, whether it is short-term or long-term. So when it comes to short-term disability policies, for people that generally don't have a lot in emergency savings and they need to supplement that income for anywhere from 3, 6, or 12 months. Long-term disability protects single income households should the breadwinner not be able to go to work to make sure that lifestyle doesn't have to change should they not be able to go to work. So when it comes to your insurance, make sure you know your deadlines for your plans. Open enrollment's different for each individual company, so make sure you know when your deadlines are and make sure you do not miss those deadlines. When it comes to your health insurance, there's going to be an open enrollment period that you need to make sure that you elect your coverages. When it comes to your 401k, oftentimes that can be changed throughout the year. Sometimes you only have certain periods in which you can change those contributions. So make sure you talk to your employee benefits manager and figure out what those deadlines are. Some key takeaways from today: don't panic, start early, and start now. If you have any questions, please contact your Cutler Investment Advisor. Thank you for listening. We'll see you next month.